Okay, so in it, Notion. So I posted a link in Notion about your investment portfolio. Okay. Now you can go to the Notion to check out your portfolio here. Okay. Okay, here is about the portfolio performance report. Okay. So this is the rate of return today. Okay, so I need you to uh, post your performance. Okay. Okay, I saw some students posting here. So if you post your returns here, you will get extra point for your performance. Okay, in the class. Okay, so try your best. Try your best, or you can also post your link. Okay, maybe you should update your link URL here. Okay, so what I mean is that you can treat this homework as an exercise, okay, which can help you to develop a habit of investment, which is important to you. Maybe in the future, you will develop a habit of watching closely the market every week, every day. Maybe sometimes in the future, you will become more sensitive to the changes in the market. Okay, so I think that would be more important. Okay, so I saw the Poulet Doge, you posted the portfolio return. Okay. Uh, any interesting to share with us? Okay, okay, just a minute. I'm trying to link to your website here. Okay, here we are. Maybe I should go down a little bit further here. Yes, you mentioned that most of investment is are on the bond ETF, right? So, so in other words, you are expecting interest rate drop, a decrease in the future, right? Mm-hmm. Okay, so okay, so this is a good direction, but my viewpoint or my suggestion is that okay, my suggestion is that because I saw your investment are high, all of your investment are highly focused on the bond, okay, okay, e bond or high yield ETF. Uh, what I mean is that maybe you should consider different types of ETFs. Okay, so because there's one case that may happen if we can see realized interest rate decrease in the near future, and probably you're wasting more time, okay, waiting for this, waiting for the interest rate decrease. But if that happened maybe 1 month later, then you were wasting so much time by not taking other more by not taking more active investment in the equity ETFs, right? So what I mean is that don't limit yourself to one specific sector or market or industry. Try to expand your analysis across different sectors, different industry, different prices, asset prices, okay, different assets, okay. So this is my suggestion, okay. Hopefully it can help you. Because I just mentioned the beginning of the class today, we have a website called Seeking Alpha, right? Seeking Alpha, maybe what if, I don't know if any one of you is doing this kind of strategy. Maybe we can just, every week we can just select the top 5 or top 4 ETFs provided by this website, okay? For example, we can see top rated ETF last week, okay? So there are some information here, but we can see the fund here. Maybe we should log in to get more information about this. Okay, but this website also provides some ETF screener, okay? So maybe you can reference this information, okay? So what I mean is that maybe some of you can try to find a more efficient way to select your investment target, because there are so many ETFs, so many stocks out there in the market. So, but we also like to find a most efficient way, okay, to make our investment. Most efficient way means we are not planning to spend so much time analyzing these ETFs. But on the other hand, we can use very efficiently. We can very efficiently find the best ETF, best investment target from the market. Okay, so maybe you should find a good way to help you to select the investment target. So I don't need you to spend so much time analyzing the market, but I need you to find a good way, okay, efficiently, okay, find a good way to select investment target, okay. So that's why we have so many ETF screeners to help us, okay. So try your best, okay. So maybe you can find a good way to do that. Okay, so this is just for fun. Okay, maybe you can just treat it as again. But we see one rate of return here. And okay, some students also posted your rate of return. So let's start from the first one. Emmanuel here. Okay, any interesting to share with us? Okay. Okay, so what if the market continue to go down this week? What kind of actions are you planning to do? Okay, okay. I remember you made some investment, maybe not all of you, but most of the ETFs are on the Bitcoin and high tech related ETFs, right? And any other industries are interesting to you? Any other industry or any other sectors? Oh, okay, okay. Okay, okay, okay. I know the market, the volatility of the Bitcoin is very high as well. Okay, so maybe you should be very sensitive to this market, and that means you should. What I mean sensitive is that you should watch very closely about the Bitcoin market every day, maybe every hour. Uh, but on the other hand, uh, just like I mentioned, you should enrich your portfolio with many different types of assets. You shouldn't limit yourself to some specific sectors or industries, okay? Because uh, there are so many opportunities out there in the market, okay? When you saw the price drop down in the Bitcoin or semiconductor companies, okay, maybe there are other companies the price of some other companies about to rise, okay, immediately. So maybe you should find a more efficient way to select your investment target, okay. So what I mean is that, okay, you can try to uh, enrich your components and portfolio. Okay. Okay. Thank you. Anyway, thank you. Very good. Okay, we have Jeremy. Jeremy, any interesting to share with us? Okay. Okay. Uh-huh.
Big institutional company doesn't really, most of them are still exiting the market, uh, especially in the Bitcoin market, because actually last week, a lot of futures position are actually closed and also liquidated last week. So that's why I think a lot of the investment are going down last week. And also for, I think that I saw in the DIA or the Dow-Jones Industrial ETF is actually making a double top currently. So I think that's a position that I will probably close in the short term because making it a double top, meaning that there's a possibility of going down in the short term. And then if the stock, if the ETF is still gonna come down in the short term, I'm probably going to do some aggressive things that depending on the market. If it's going to the short term, I'm probably going to open an STQQ position, which is a short positioning to the Nasdaq ETF. But if the market is going slightly up, I'm probably going to put a buy option for the STQQ, which is a leverage portfolio Nasdaq.
Okay. It seems to me that most of the investment are limited to the high tech and European market, right? Okay, 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 great. Have you considered other markets like Asian markets or not particularly? Okay. Okay, okay, okay. Okay, okay. Oh, okay. Have you included the market of Russia? Because last week I saw the news about the Russia market, because the Russia has been engaged in the war between in Ukraine, and most people don't like the Russian financial market. But however, if you check out the chart of the Russian market, you probably see there's a upward trend, and in the near future, maybe we don't know that, but maybe what I mean is that sometimes most people don't like this market. Maybe there's a good chance for you to get profits from the markets of Russia. We don't know that. Yeah. Yes, yes, yes. Yeah, yeah. Okay, that's interesting. Uh, but okay, thank you for your sharing. Okay, great. Okay, we have another student, Fan Min. Any interesting to share with us? That's fine. If you didn't do anything, that's fine. What I mean is that, okay. Uh, oh, sorry. Okay, okay, got it. Yeah. Okay, great. Yeah, your report is the most detailed one. Okay. Mm-hmm. Mm-hmm. Yeah. Okay. Okay, that's fine. So you change your strategy a little bit and put some money, put some investment on the bond market, right? Okay. Any special reason for that? Mm. Okay, okay. Thank you, thank you. That's very interesting. Uh, so have you tried any tools to help you to select your investment targets, for example, like ETF screener or any other screener to help you? Okay, okay, okay. Thank you, thank you. Okay, very helpful. Uh, so if some of you try to use different screener, you can also share your experience with all of us here. For example, this week I introduced the Seeking Alpha. Okay, so this is also a good website to help you to. But I know basically if you want to get more important information from this website, sometimes you need to pay some money to get a higher level of membership. Okay, but I know we don't have so much money to spend on this website. So what we can do is try your best, just try your best to take advantage of the benefits that this website can provide for free. Okay, so maybe some students can find a good way to efficiently okay, select their investment target. So if that's the case, then I hope you can share your good ideas or good approaches, okay, selecting your investment target. Okay, so this is the purpose, okay. Basically, the purpose of this homework, okay, to just to exchange everybody's idea, okay. Okay, so let's go back to our PPT here, okay. So here we have some formula here, okay, just a minute. Yeah, of course, here are some, we mentioned some equations here, okay? Maybe these equations are a little bit difficult to you, but it's not that important right now, okay? All you have to know is that, okay, we have a single index model. So what is a single index model? You have to know the meaning of the single index model, and then you have to able to calculate the return of the assets, okay, based on single index model. And in addition to that, you also have to know, okay, based on the single index model, how can we calculate the risk of the individual assets? Okay, or put it another way, we have based on the single index model, we have a different formula to calculate the risk of the individual assets. So before we know the single index, before we learn the single index model, we just used the most standard way, using statistical variance to calculate the risk, to measure the risk. However, after we learn the single index model, we know how to use the single index model to simplify the calculation of the individual asset risk. Okay, so now we have a total risk. Okay, we define the total risk as the systematic risk plus the firm specific risk. Okay, so that would be a lot easier for us to calculate the variance of the risk of individual assets. Okay, so here we are here. Now we see that based on this, then we can derive, we can see the relationship between the portfolio risk versus the number of assets. Okay, so you can see the portion above the horizontal line here refers to the diversifiable risk. Okay, and the lower part of this block refers to systematic risk. So in other words, systematic risk is undiversifiable. Okay, which means that cannot be diversified, even though we include as many assets as we can in our portfolio. So this is called a systematic risk. Or put in another way, all of us, for human beings living in this earth, okay, because we only have one earth, okay, to live in. So the systematic risk refers to the stability of the stability of the earth, okay, the living environment of the earth. So this is also called a systematic risk. Okay, so now that's why we are more we are becoming more and more uh, careful of the environment risk. For example, we have environment. We like to emphasize the environmental issues. We like to emphasize the green effects. Okay, and this is becoming these kind of issues are becoming more and more popular in recent years. Okay, so the reason is, okay, we really care about the systematic risk of the Earth. Okay, so this is just for your reference here. And then we can see this chart. This is a market index in black line, and this is the blue line is the Amazon. Okay, Amazon rate excess returns. So you can see basically Amazon is more volatile than the market index. Okay, and a y-axis refers to excess returns. Okay. So usually when we talk about the excess returns, we just deduct the risk-free rate, okay, from the asset returns. Okay. So in scatter plot, this is the scatter diagram. The y-axis is monthly excess returns of Amazon. And the x-axis is monthly excess returns, the market index. Okay, so based on this, you can see a linear line here. So the linear line here is about the index model we just mentioned in the beginning. So we have a RI, okay, excess returns. RI equals to alpha plus beta times the market excess returns. Okay, so this is the linear return. So you can see very clearly that the beta here is positive. Okay, so that means the market, the Amazon excess return of Amazon is moving maybe not so closely, but we can see there's a positive relationship between Amazon rate of return and the market excess returns. Okay. Okay, so this is just for your reference, but not all stocks has a positive slope, okay, in this regression line. Okay, so moving on to the next slides. In this case, we have a line called security characteristic line. Okay, so now we can see we are using the S&P 500 as a proxy for the market index. Okay, so here we have a RI equals to alpha I. Okay, now you can see we have notations here. Alpha I refers to expected excess return when the market excess return is 0. Okay, remember the website we just mentioned called the Seeking Alpha. Okay, what is alpha exactly referring to? The alpha means the alpha here. Okay, so that means when the market excess return is 0, this assets can generate a positive alpha. Okay, so this is important. So we are seeking for the assets that can generate a high value alpha. Okay, so that means this is important in our portfolio selection. Okay, and then beta here refers to the sensitivity of security I's return, the change in the rate of in the return of the market. But remember, because this is just a regression line, so this may not be so stable. Okay, because when we run this regression, we have to usually we have to know that, okay, this beta is not very stable in some period of time. Okay, so sometimes, okay, maybe the stocks has a very stable relationship with the market index, for example, like S&P 500, but sometimes this stock may be very volatile. Okay, and this is represents maybe this company is experiencing a different period of growth or different development period. Okay, so that will also affect the rate of return of stocks. Okay, so we have some explanation for this. Okay, and EIT here. Okay, we usually refer this term as a residual term. So because you haven't learned the regression model, but to understand this, you can just imagine that. Okay, statistically, we're assuming that this residual term EI, okay, residual term is has a zero mean, okay, which means the expected return, expected value of this EI is zero, okay. And this is also called the firm-specific surprise in security I's return in Monte. Okay, but in regression, we like to use a different term for this. We call this as a residual. Okay, residual means something left and that cannot be explained by the model. We call this as a residual. Okay. Okay, so this is about the regression line here. Okay, so after we run the regression, then we can calculate we can get the following statistics. So this is a very standard statistics. Okay, running the regression, we got the coefficient. Okay, first of all, let's check out the coefficient. We have an intercept. Okay, so this is referring to alpha. Okay, you can see here alpha is 0.0192 and the Mach index coefficient is 1.5326. So this refers to the estimated beta. Okay, so the first one here, intercept is alpha. Okay, coefficient, you can check the column of coefficients here. The first one is alpha, the second one is beta. Okay, and then we also have some estimated statistics like standard error, t-statistics, and p-value. Okay, so this is very standard way. Okay, in statistics and the regressions. So usually we like to check if value is significant, if the estimated coefficient is significant or not, then we usually check the p-value. Okay, so for in this case, we have a very significant beta, okay, in our Mach index. So that means this Mach index is very powerful in explaining the stock returns. Okay, so you can see this p-value is very close to zero. Okay, on the other hand, for the intercept, the p-value is also less than 5%. So maybe we can call this this intercept as a significant value as well. So in this case, for intercept and alpha, okay, intercept alpha and the Mach index beta, okay, both estimated coefficients are significant. So in other words, this equation can explain the returns, okay, very good, with a very good explanation power. Okay, so this is about the regression statistics. So, but you can see the title here. This is based on the Excel output. Okay, so in other words, you can also use Excel to generate the results without any problem. Okay, but in my course, I require all of you to be able to use R. Okay, R program. Okay, so I think this is important. Of course, I will show you how to run the regression maybe later, but you can see this is not that difficult. Okay, so now we have some more interesting things here. The industry version of the index model. Okay, so because we only have consider one market index as a factor to explain the returns. Okay, so the thing is that, okay, maybe we can find other variables, okay, or find variables to help us to predict the beta. Okay, because just like I mentioned, the beta tends to change in different time of period, different times of period. For example, like right now, maybe you can see when the stock index, when the market index is see a very strong upward trend, probably you will see some major stocks in the financial markets will also have a very high beta, okay, closely moving with the market index. But sometimes, okay, if you see the market index is going down, maybe you will see a different story in the estimated beta. So beta tend to drift to one over time, but sometimes it's not the case in the real world. Okay, but if we check the beta in the very long term, maybe the beta tends, okay, to drift up, sometimes higher than one, sometimes lower than one over time. Okay, so in the real world industry version, okay, Rosenberg and Guy found the following variables to help to predict the beta. Okay, so we can also consider different factors like variance of earnings. Okay, so this is the first one, variance of cash flow, growth in earnings per share, market capitalization, dividend yield, debt to asset ratio. Okay, of course, you can also modify these variables, okay, or make some adjustment to these variables and test if your customized variables can help you to predict the beta. Okay. Okay, so other issues like alpha and security analysis. First of all, we have just I like students to analyze the market from the global market. So that's why, first of all, you should become more and more familiar with the macroeconomic analysis. Okay, so what I mean is that, okay, for the systematic risk, okay, for the systematic risk, you should be, if you know or understand the logic behind these macroeconomic policies, then you will be more sensitive to the systematic risk. Okay, in other words, if you are able to predict the systematic risk, that means you are able to predict the stock prices, okay, more easily. Okay, so that's why you should understand the economic policies. Okay, for example, macroeconomic policies. For example, uh, just like I mentioned, why Japan will take changes in their interest rate policy, or why the USA will like to increase interest rate in the near future. Or what's the possibility of the government of U.S. government or Japanese government raise the interest rate in the near future? Okay, so you have to understand the reason. Okay, so if you can understand, if you can know a little bit more about the macroeconomic analysis, then you can better control the price stock changes in the future. Okay, so this is important. Okay, other issues like statistical analysis used to estimate beta coefficient residual covariance of all securities. Okay, so this is about the statistical analysis. And then establish expected return of each security absent any contribution from security analysis. Okay, so this is completely based on the single index model. Okay, because we have so many information resources, we have to if we consider so many information resources, probably we will be misled by these resources. So basically we have to establish a good way, okay, to calculate expected return of each security. And then security specific expected return forecasts are derived from various security variation model. Because right now we are using so many models in the market, but one of the most popular method to select stocks from the market is the one developed by the Warren Buffett. Okay, so are you familiar with the selection approach by Warren Buffett? No? I suggest you to check out the YouTube. Okay, there are some videos on the YouTube telling you what's the ways, okay, used by Warren Buffett, and then why he was so successful in the past decades. Okay, however, in different markets, we should develop different ways to select stocks or investment targets. So what I mean is that you can reference the selection approach by Warren Buffett, okay, but you should customize his ways, okay, and to find a good way, okay, most appropriate to you, okay, and then you can try to test if this selection process is working or not. Okay. Okay. So here are some exercise. Okay, just to help you to estimate the model. We have a single index model. So single index model input. Okay, we can just use S&P 500, okay, as a proxy for market index. So we can calculate the risk premium of S&P 500. We can also calculate the standard deviation of S&P 500 and assets of estimates. So we can calculate the beta coefficient. We can calculate the stock residual variance. We can also calculate the alpha values. Okay, so in the following, I will give you a brief introduction about this process, because we have so many stocks in the market. Okay, so if you want to calculate the stocks, every stock's beta, alpha, beta, okay, that's gonna take you a lot of time. So that's why we need to use the codings to help us to do that. Okay. Okay. In the following, we have equation to calculate the expected returns of the portfolio. Okay. So optimal risky portfolio in a single index model. So how to calculate the optimal risky portfolio. So what is optimal risky portfolio? So here's the objective function here. Objective is to select the portfolio weights to maximize the Sharpe ratio of the portfolio. So okay, so what is Sharpe ratio is referring to? Okay, now you can see we have three equations here. Okay, the first one is expected return portfolio here, EP. The second one is sigma P. And the last one is SP. SP refers to Sharpe ratio. Okay, Sharpe ratio is defined as the ratio of expected return divided by the risk. So expected return here, EP, is the expected return of portfolio. and divided by the standard deviation of the portfolio. So now we have two formulas here. In the numerator, here in numerator, expected portfolio return portfolio, return on portfolio, right? So we have equation of this. However, we also have to consider weightings or weights, because we have assets. We have so many assets in our portfolio, so we have to we have to consider using different weightings for each assets, okay, and then try to combine them together. So we have an expected portfolio here. We can have a alpha P plus expected return on market, return on market, and times the beta P. Okay, and then for alpha P, okay, we just taking the average of the assets here, okay, and then we also have the beta P, beta I, okay, beta P. So we are also taking the weighted average of the beta. Okay, so this is how we calculate expected return on portfolio. Okay, so the sigma of P. Okay, for the second equation, we have a variance of portfolio. So based on this, okay, then probably we need to derive the equation here, and then you can see the sigma P squared times sigma N here, okay, sigma N squared here, okay. So what we have here is, okay, now we have a weight. We're gonna take the square of the weighted average of beta. Okay, also for the residual variance, okay, we also have to take the weighted average, okay, but remember here we have to take the weight of square here, okay, so that refers to Wi squared times the sigma square of EI. So this may be a little bit complicated to you, okay, but never mind. Don't worry. Don't get yourself stuck here by this equation. Okay, basically, what we are trying to do is, okay, we do have a formula to help us to derive to get the answer. Okay, so what we are trying to do is we have to minimize the SP. To maximize the SP here. Okay, so these questions can be solved by the codings. Okay, not to mention the Excel. Okay, in this case, the textbook emphasize that all examples can be implemented in Excel. Okay, so if you like, you can also use Excel to help you to find the solution. But what I mean is that if you can use R to help you, that will become more easier, okay, to do that. Okay, so let's take a break and then we'll come back this problem or exercise later. Okay, just take a break.